Now, folks, here's where we get into the next fun-filled category. And spoiler alert, this is going to be your first introduction to math. Yeah, that four-letter word that makes some of you throw up in your mouth or do that, whichever. And yeah, it's okay. We're going to get through it. But you're going to get exposed to some math in this section. So this one deals with property taxation and assessment. So there's a couple things I got to get into before we get into the math. And this is also where I'm going to start explaining some of the really pain in the butt differentiations between national and the state test. So, so real property taxes we've talked about a little bit already. Of course, we're going to talk about how to calculate them in some other pieces like, assessed values, mill rates, per 100 rates. When we're dealing with North Carolina, let's just start there, okay? In North Carolina, we have what we call the Machinery Act, and the Machinery Act gives individual municipalities the right to tax real property. If you didn't know this, when you pay real property taxes, it's not going to the IRS, it's not going to the White House, it's not going to the state even. It is local in nature. So your taxing bodies are your counties and your cities and your townships. Okay, they're very local. All of your real property taxes stay in your community. Very local in nature. And so when we're talking about real property taxes, they are sometimes referred to as general ad valorem taxes. Yet again, weird language, loosely translates to general assessed value tax. Now, technically, there is assessed value tax on your car as well. So we're talking about real property taxes because your personal property taxes on your car are based on your assumed value of your car, just like they are on real estate or real property. The assumed value of your real estate. We call that assessed value or ad valorem. So in North Carolina, the Machinery Act states that from a taxing point of view, the taxing authorities, counties and cities, when you hear me say the word municipalities, that's just a generalized term for cities and townships, okay? North Carolina has 100 counties and like 552 municipalities. So when I say that, it means towns and cities. So what happens is, in North Carolina, the tax assessor is required to reassess the value of your property every 8 years. It is called a mandatory octennial reappraisal. Octo meaning 8, right? Like an octagon has 8 sides. Mandatory octennial reappraisal. They have to reassess the property values every 8 years. They can reassess the property values every 4 years. It's called a horizontal reassessment. Horizontal means across the board. So they cannot do it to certain homes and certain neighborhoods. They would have to do it for the entire city and or county. So every 4 years they can do it. Every 8 years they have to do it. Now let me make a very, very powerful statement. Listen to me very, very carefully. If I asked you how often the tax value had to be reassessed in North Carolina, at minimum, you're going to tell me what? 8. But here is the big word of caution because these test questions eat students alive. They will also talk about the tax rate. And folks, the tax rate can and does change every single year. So if the test question says, how often can the tax rate change? Don't you pick 8 years. It's every year. We're going to explain the rate more in a second. But what we're basing it off of, right? The rate is based off your assessed value. So we take this tax rate and we're using that to calculate your tax bill based on your current assessed value. Does everybody understand that distinction? I cannot tell you. And here's one reason I'm warning you about this, folks. As a cocky real estate instructor, every once in a while, I'll be incorporating some new test questions, and I'll just fly through and take them. You know what I do for fun? This is depressing. You know what I say I used to do this for fun, and we'll use the term fun loosely. When I incorporate new test questions, I will literally sit on my phone after my kids and everybody are asleep, and I will start taking the quizzes myself while I drink a big old glass of bourbon or something. I'm like, I don't need to be sober for this. I can just take these test questions. And I have found that I have made that mistake as an instructor that knows this stuff inside and out, because I'm just like, that's an easy question. 8 years. And then I'm like, oh, it's just the tax rate, stupid. You teach this for a living and you still got caught. So if it's tricking me sometimes, right, I'm really trying to warn you that tax rate can and does change every single year. Jack, I saw your hand up. Is this your question you had in the chat, I'm assuming? Is assessed tax value updated to the sales price when there's a sale of property? That is an excellent question, Jack, and the answer is no. Understand, there is zero correlation between what the property sold for and what the assessed value is. Even though they like to think that there's a correlation, it is literally the tax assessor's own appraiser saying, here's what we think it's worth. That's it. It has no correlation. So your tax value and the sales potential price, zero correlation at all. None. Yeah, that's some pretty good advice, Brooks. Maybe don't test while drinking. Perhaps that's why I missed that question, right? Maybe it was on my third or fourth glass of bourbon. Okay, who knows? Maybe, I don't know. Maybe I just missed it. Yeah, zero correlation. The other thing that you have to understand, even if there was a correlation, sometimes they're not being reevaluated, and except for, like we said, every 8 years. And so when they assess your property, well, folks, things have a tendency to appreciate, get more valuable as time goes on. And so if they assessed it on year one, and now it's 7 years from that, it should hopefully sell for a lot more than what that tax value was 7 years ago, because there's going to be this disparity as time goes on. But this is one of the hardest things for people to understand. There is absolutely zero correlation with tax value and sales price in North Carolina. None. Zero. Zip. Nada. We don't even look at that. We have to tell people what it is for disclosure purposes, what their tax bill is going to be. But that's not even a consideration when we're pricing the properties. What you got, Brooks?
So if the tax value is not, included into the sale price, does the market value get adjusted every 8 years to compensate for the tax rate?
So here's where you got to be very careful about language, and here's why. In this class, market value is what an appraiser says a home is worth. That's the definition of market value for the sake of this class. What the property actually sold for is called market price. So those are all different things, right? You've got your assessed value, which is what some random person who works at the tax assessor's office thinks your property would probably sell for, but really has no correlation. You've got your market value, which is what an appraiser thinks that it would sell for in an open competitive market, and they kind of know what they're talking about a little bit more. And then what it actually ends up selling for, we call market price. Does that answer your question? Kinda?
Kinda, sorta, maybe.
The point is,
maybe I should wait until later in the unit.
Yeah, that's probably going to be good. We don't make adjustments, right? The market adjusts itself, right? Supply and demand, the market adjusts itself. And so market value goes up as there's more demand and less supply, and areas have a tendency to appreciate, and a lot of other factors. Nobody's ever making adjustments, but it'll make more sense later, because we determine probable sales price as real estate brokers by looking at comparable sales that have recently sold. So it does kind of adjust because of that. So
you said comparable sales. Do people take because I know I witnessed a sale of a house that was started pre-COVID, and then it rapidly inflated right when all the shutdowns hit.
Mm-hmm.
So is COVID kind of the outlier, like the very beginning of the spike?
Yeah.
Outlier.
And so this is a perfect case in point. That is what we call appreciation, and properties have always had a tendency to appreciate. We didn't make that adjustment. The market made that adjustment because interest rates went so low, the demand was so high. Now, that was a very atypical thing. It would be an outlier for the very cyclical real estate market that we've seen. But it was the supply and demand that caused it to be that much more in value, that super fast inflation, if you will, or appreciation, because of a lot of different factors, but namely supply and demand. Everybody was moving away from California and New York and all these places that were crazy expensive, and now they had these high-paying jobs and they could work from anywhere because remote became a thing. So people were moving here, and because there's so many people transplanting to North Carolina that were cash buyers from these crazy markets, things went nuts. So what you're seeing now is called a cool down, because they keep the rates high, so things kind of level off a little bit. Yeah, absolutely. That's exactly right. I'm sorry, Bill, you had your hand up. What you got?
Yeah, so why is it that assessed value is always lower than market value? Like, I've bought houses in many different states throughout the years, and it's always lower, no matter what state, no matter when the assessment happened. It's always lower.
I'll give you a really easy comparison here. Okay, imagine you buy a car for $20,000, and then you get a tax bill for your car, for your registration that year, for your personal property taxes, and they say, well, we think your car is worth $40,000. Here's your tax bill. What are you going to do? You bought it for $20,000. They're charging you taxes based on a value of $40,000. What are you going to do?
I'm going to complain.
Nailed it. Nobody is ever going to be okay. Like, if they came, like, that is the one time we want to pretend our houses are worthless. Because if we're having to pay these ungodly amounts of tax, they're not dumb. They know that if they went higher than what you could sell it for, you're going to complain, you're going to contest, and you're going to say, my house is not worth that because I don't want to pay taxes on that much. So they always try to keep it a little bit lower so you don't complain. Does that make sense? And then, of course, as
I would never complain about it being lower. I just noticed that that's a trend across.
It is, and for good reason.
States I've owned houses in.
They do not want every single homeowner in the state of North Carolina to contest it, and then they have to reevaluate it and have an appeal and do all these things. So they very strategically have noticed that same thing. They go a little bit lower, and then, of course, as I said, when they evaluate it, they may not look at it again for 4 years, or they may not look at it again for 8 years. And by that point, your house is worth a lot more because of appreciation, like Brooks was talking about. And so there's going to be a bigger disparity at that point. That's why. Sergio says, just stop raising my taxes. Hashtag same, right? Lord have mercy, man. Listen, existing isn't even affordable anymore, okay? I don't know who's making these decisions. This is not. Bree, you had your hand up.
Yeah, I was asking a similar question as Bill, but I was asking more so, was it lower because they're not coming to your house, or is it?
Yeah, I mean, that's a factor. But like I said, they err on the side of caution for obvious reasons. So I don't really know what their formula is, but it's always a little bit lower because they just don't want to deal with the headache of trying to say your house is worth more than what you could sell it for. That's never going to fly with the general public. Yeah. So zero correlation there. And so as I said, when we're trying to deal with this tax assessor's assessment, they strive to be market value, but as I just explained, there's no correlation, right? So that's why we call it assessed value. Now, why is this important, folks? When you're dealing with test questions, there's a couple anomalies, but when you're dealing with test questions, you could see market value, purchase price, loan amount, and assessed value in one test question. If it's asking you to calculate the tax bill, you have to make sure you're using the assessed value. There's a few anomalies that we'll talk about later, but assessed value is what taxes are always going to be based off of, but in a nutshell. And as I already pointed out, as time goes on, things have a tendency to have a bigger disparity. So let me explain something, folks. We're going to continue to focus on North Carolina, but I need you to understand something really quick. There are going to be math questions on the test based on taxes. And all the math on the test is on the national portion of the test. Which means, while I want you to focus on understanding taxes in North Carolina, you will realize that when you get to math questions, they will not necessarily make sense for North Carolina. And so as a precursor to teaching you math, let me explain a very important math concept. I need you to burn this into your brain. So when you see a math question on the test, this is what you hear. Okay, you hear my voice saying this in your head when you're taking the test. Ready for this? You have to treat math questions on the test as a hostage situation. Let me translate that for you. Do what the question says and nobody gets hurt. Do not ever think that you are smarter than the math question. Case in point, taxes in North Carolina, if you look right here, taxes in North Carolina are not technically considered due and payable until September 1 every year. But you could see a test question on the national side that says the seller paid their tax bill on February 2nd. Don't be like, oh, this is a trick question. They can't pay it yet. Yes, they can. Some states, they will pay it as early as January 1. I'm going to teach you how to navigate this, but you've got to listen to me. Math questions are a hostage situation. Do not ever think you're smarter than the math question. Do what it says. Period. Everybody with me? Now, we've said that. Let me continue teaching you North Carolina, and then I'll circle back to the national side and what you need to be aware of. So we said that real property taxes, you have to pay them every year when you own real property in North Carolina. And so because of that, we say that the tax lien attaches to your property on January 1. Well, folks, this is what we call an unrecorded document. There are so many homes in North Carolina. Can you imagine if it cost money and it's filing of paperwork, what that would entail to put a tax lien on every house in North Carolina on January 1? So we don't actually record it, but it's said to be there. We know you're going to owe taxes this year. Everybody does. So we say that the tax lien attaches to your property as of January 1. And then by January 31st, it says all real and personal property listed. If you own a house, you've seen this. You get a notice from the tax assessor, and they say, here's what we have for you. Is this what we should be taxing you on? In other words, have you made any additions or improvements that we need to be aware of so we can tax you differently? That's not really something you need to know for the test, but just so you're aware. Now, I told you, at minimum, the assessed value has to be reassessed every 8 years. But as I stated, the tax rate can and does change every single year. And so the rate is not set until July 1st of each year. So you actually don't even know your tax bill until sometime after July 1. And that is why we do not consider the tax bill due and payable until September 1st in North Carolina. So most people pay their tax bill sometime after September 1, and as long as they pay it prior to January 5th, by or on January 5th of the following year, it's on time. When January 6th of the following year hits, it's delinquent, past due. So right now, we are in the 2024 tax year. It is October. A lot of people who have escrow accounts, your tax bill may have already been paid. If you own your house outright and you haven't paid it yet, you need to pay it before January 5th of next year. Otherwise, it's delinquent. Genesis says, daily questions I get at the bank. Why are my taxes this more this year, and why are my escrows in the negative? Because all of the values and all of our local counties have gone up in the past 4 years. Wake County was last year, Harnett was the year before that, Johnson was the year before that. They have all gone up, which means all the taxes have gone up, and aside from that, insurance has gone up, which means the money that was in your escrow account before is no longer sufficient, and they had to readjust it, and everybody's payments are going up. Isn't that lovely? I'll talk more about that in the financing section. So if I was to give you a visual of this timeline, right, tax liens placed on your property on January 1, and your tax bill is considered due and payable on September 1. Well, folks, here's the thing you have to understand. Are people selling houses throughout the year? Sure they are. January, February, March, April, May, June, July, August, all of the months. And so why is this important? Now, I'm going to kind of put the cart before the horse, as they say. I'm going to teach you something that I'm not actually teaching you, but I'm going to help you understand a very important concept. Imagine that you own a house and you are selling it, and your annual tax bill is $4,000, okay? Every single year, you have to pay the tax assessor $4,000. And you sell your house on July 1st. If the tax bill is not due and payable until September 1, which you're selling it before then, who's going to pay the tax bill? Jack says the buyer. Well, based on this timeline, you're right. Now, here's my question. Would that be fair? Is it fair for the buyer to have to pay that full $4,000? Lena says it's prorated, and you're absolutely right. Folks, here's the thing. When there is an annual bill, we will prorate it. Proration is dividing the bill between the parties. Here's the best analogy I can give you, okay? If you ever go out to eat with a friend, and you're going to pay for yours and your friend's going to pay for theirs, and imagine, let's just use some realistic numbers here. Imagine that your bill is $60 and your friend's bill is $40. But they bring one check out for a total of $100. Well, you paying $100 is not really fair. Them paying $100 is not really fair. But what about this? What about if they bring this one bill for $100 and you say, well, hey, I have my card, but I don't have any cash. Let's just make it easy and not make them split the checks. I'll swipe my card for $100 and you pay me $40. Is life fair at that point? Sure. Couldn't we do it the other way around? Even though the friend's portion is smaller, what if the friend says, well, listen, I don't have any cash, but I'll swipe my card for $100 and you give me $60. Still fair, right? What if you both have cash? Couldn't you just put 60 plus tip in the book and they put 40 plus tip in the book and then we just pay it that way? Folks, taxes work the exact same way as this analogy I just gave you. Think about it. It's all about making life fair. And so if you're closing on a property July 1, well, there's a portion of that tax bill that you ate. What did you order? Well, you ate January 1 up through July 1st. And then everything after that is the buyer's. Just like that food bill. Does that make sense for everybody? Now, this is where it gets a little more interesting because of different things. First and foremost, the default is the seller is responsible for the day of closing. Okay, the individual day of closing. So that means that the seller in this scenario would be responsible for January 1 through July 1st. And that means that the buyer is responsible for July 2nd through December 31st. Pretty straightforward. But here's the problem. I told you we can't pay the tax bill until after September. The tax assessor doesn't want it. I'm not saying you couldn't, but for the sake of convenience and understanding, let's say can't. So how do we make this fair, do you think? If we're closing on July 1, what would we do to make this fair between the buyer and the seller? Escrow, trust account, take it out of the closing cost, prorate and escrow. All good guesses. You're kind of right, but here's the thing, folks. Escrow, it's a little more complicated because then that means like a third party has to keep an eye on it. So here's what we do. It's exactly like the analogy I just gave you with the going out to eat. What we're going to do is we're going to take cash from the seller for their portion, and we're just going to give it to the buyer at closing. We're just going to give it to them. And so let me introduce a very important set of terminology. When we're looking at a closing disclosure later, the itemized list of costs on the settlement statement or closing disclosure, you'll hear me use both of those terms. There is what we call credits and there is what we call debits. Okay, this is going to be very testable, but this is just your initial introduction to it. And here's how I want you to think of credits and debits, folks. If you swipe your debit card, what happens to the money in your bank account?
It goes down.
It goes down. It gets taken out, right? It goes away. So a debit is taking money from somebody. I want you to think about this before you answer. When you swipe your credit card, what just happened?
There's a charge that then has to be paid off at a later time.
Sure, but in that moment, somebody gave you money, didn't they? American Express, MasterCard, Visa, somebody gave you money. That's exactly right. So a credit is giving you money, and a debit is taking money from you. Everybody cool with that statement? It's going to be a very testable aspect that we're going to talk about a lot in this class. And so here's what happens. We would say, okay, well, let's debit, and I'll show you the math in a second, but just for convenience purposes, let's say that the seller's portion was, July is kind of right there in the middle. Let's just say it's $2,000. We are going to debit the seller $2,000, take it from them, and we are going to credit the buyer that $2,000. It just gets given to the buyer. It goes towards all their other costs. And so what's going to happen is later in the year, after September 1, the buyer will pay the full $4,000, but it will be fair. Why? Because the seller gave him $2,000. Does that make sense? That's it. Now, sometimes we close after September where the seller's already paid it. Well, folks, it's just the opposite. Imagine that the seller's already paid the full tax bill. Now, at closing, we would take money from the buyer and reimburse the seller. Think about it as the restaurant analogy. Who swiped their card? How do we make it fair? Now, of course, the last circumstance, hang tight, Brooks, I'll give you that information. The last circumstance, folks, is let's say that you're closing after September 1. Let me just clear everything out here. And it hasn't been paid yet. The attorney's not going to be like, it'll be all right. No. If it's after September 1 and it's not been paid, it's considered due and payable. So that's where the you put cash in the book, you put cash in the book comparison comes in. It's what we call a double debit. So we're going to take the seller's portion from the seller. We're going to take the buyer's portion from the buyer. And the attorney is going to pay the tax assessor the $4,000 at closing. That's it. Those are the three options. Closing early in the year, seller debit, buyer credit. Closing at the end of the year and the seller's already paid it, buyer debit, seller credit. And if we're closing later in the year and it's been unpaid, but it's due and payable, double debit. Now, I'm not teaching you the prorations yet. I'm going to show you what they look like. Please don't consider it the lesson. I'll teach you that later. I really just want you to understand it. What you got, Bree?
This may, you can always just say that's part of what I'm going to teach you later.
Sure.
But you're saying credit and debit. Are you saying this is happening at closing? Like they're taking the money and adding? Who is crediting and debiting?
The attorney.
Oh, the attorney.
Yeah, the attorney who's facilitating closing. So, if you buy a house, it'll tell the buyer oh, you need this much cash to close. So it just says bring this much, right? And same thing for the seller. Sellers just gets taken out of their proceeds. Buyers have to bring money to closing. So the attorney is calculating all this. Basically, what a closing disclosure or settlement statement is an itemized list of all the credits and debits on behalf of the seller and an itemized list of all the credits and debits on behalf of a buyer. And so all of that gets netted out.
And this just goes to the county or whatever, and they will keep record of that.
Yeah, the bill gets paid to the tax assessor. The tax assessor doesn't care about the prorations. Why? Because they just know that they're going to get $4,000 after September 1. So when the buyer pays it, the tax assessor doesn't care or need to know that happened at closing. It's irrelevant because the attorney handled that. They just need to know that the bill gets paid.
Okay.
Yeah. What you got, Janet?
Okay, so this is kind of like what happened to me this year. I purchased my house this year in June. So when we were gonna sign the paperwork, the person that sell the house, they paid part of the taxes and made me pay the other part. So for this next year, 2025, am I going to be paying in September the 1st?
Yeah, just out of curiosity, when did you close on your house?
June the 24th.
So let me just clarify a couple things here. June 24th would fall earlier in the year, and so they should have been giving you money, and your escrow account should have paid your taxes later in the year. Now, this is why I told you, typically the understanding in North Carolina is, you're not going to pay your tax bill until September 1. Can you do prepaid installments to this tax assessor before that? Yes, but it's an estimate because we don't know the exact tax bill until later. Now, I don't know technically what's on your settlement statement, but the point is, you close this year, And I'm assuming you have a loan, right, Janet?
So they told me that, yeah, they told me not to worry about taxes this year.
Yeah, that's because, well, you're not going to have to worry about them next year either, most likely, because you will have what's called a budget loan more than likely, which means each month when you make a payment, there's money going into an escrow account for you that the bank holds, and the bank is going to cut that check for you to the tax assessor this year, and they will do the same thing next year. That's what Genesis was just talking about. People's escrows are getting funky because tax bills are going up and insurance bills are going up. So you're not going to have to pay it out of pocket ever as long as you've got a budget loan, but you may have a payment adjustment if there's not enough money in your escrow account to pay it next year.
Okay.
Yeah.
All right.
Yeah. It'll make more sense as time goes on, I promise. And Jack, yes, thank you. Attorney. The attorneys handle these settlement statements. Now, going back to Brooks's question, does any of this change if it's a new build? Yes, because a new build the year prior was typically dirt. And so it gets a little more complicated because we don't know the tax bill for any given year until the rate's been set. So we typically just base it on the previous year because that's as close as we can get. With new construction, it's hard because last year it was worth $10,000. This year it's worth $500,000. And of course, we won't know exactly what that tax bill looks like. So it does get a little more iffy. The timetables technically still stand, but the estimations change quite a bit for new construction. It gets a little iffy. Now let me just show you folks, and I'm going to give you one more really big piece of insight here. And this is where sometimes I feel like I'm like violating the Geneva Convention. Some things in this class are just cruel. And I just feel like I'm just like torturing y'all and the worst person alive. But please understand, it's not me. It's them just making me teach it to you. So here's a little bit of story time, okay? When we're dealing with this class, we have always taught that the default way of calculating, or in other words, the way of calculating this is, for the sake of this class, you pretend that every year has 360 days. And you pretend that every month has 30 days. Why? My best guess for whoever came up with this was because we never wanted you to get a proration question wrong because you didn't remember February had 28, or you didn't remember that, July had 31. You see what I'm saying? Because you're not going to have a cell phone or a calendar in your pocket. And so at least this was some consistency on the test. Here's the terrible part. True story. A year ago, year and a half, 2 years, I can't remember now, I'm getting old. I had a student come through my pre-licensing class, and we taught this religiously. To the extent, like I would tell them that we do the 360-day year, 30-day month. And then I would ask them, how many days are in February? And they'd be like, 28. And I'd be like, no, 30. And then we try it with October. I say, how many days are in October? And they say 31. I said, no, 30. We really just had to impress this upon you because this is how it was tested. Here's the bad part. I had a student go through my class. And she went and she took the test and she passed it. And she reached out. She said, oh my God, Seth, thank you so much. I felt so prepared. Like you went over everything. But I want to tell you something. I said, what you got? She said, you said that there would only ever be the 360-day year, 30-day month method on the test. But I had math questions that asked me to do a real calendar year method. And I was like, no. And so, of course, I'm thinking, okay, well, she just had some PTSD. She was a little stressed. She doesn't know what she's talking about, right? That test really got to her. So here's what I did. I reached out to the commission. I said, listen, I need y'all to answer something for me, okay? I had a student who was very sharp tell me that y'all were testing both methods on the test when you have always told us to only teach this one. And the commission responded, we'll look into it and we'll get back to you. A couple weeks later, Seth, we went and looked at the test. Your student's absolutely right. Both methods are on the test. And they very sneakily, updated, our syllabus and said, primarily using the 360-day method, but could see the 365-day method, which, in my opinion, completely defeats the purpose of even giving you this method to start. Because why not just teach you the real crap from the word go if you're going to test them on both? You see what I'm saying? This stuff makes me want to drink. Okay, it is cruel and unusual. This is why I'm telling you I feel like a terrible person. I'm just waterboarding people, educationally speaking. It's terrible. So let me show you what this looks like. This is not me formally teaching it, but let me show you what this looks like. Hand me the tequila. It's #same. Okay, I get it. I'm sorry. All right, it's not me. It's them. What you got, Donna?
let me just make sure I'm playing back what I'm hearing you say, Seth. What I'm hearing you say is that for the class test, it's the 360 30-day rule. But on the exam, the national exam, it could be calendar and this rule. Is that what I heard you say?
Yes.
Okay, just making sure I heard
And
you correct.
and the default is 360-day year, 30-day month. But if they want you to do the other one, they will say using the 365-day year. That's what they will say. I'm going to show you what both look like. And this goes back to what I taught you about math questions already. Do what the question says and nobody gets hurt. So, if we had let's just use that number I gave you before, $4,000 tax bill. And let's say that we were closing, I'll just use an easier number for the sake of showing you how this works, March 5th, or an easier date. Okay, March 5th closing. Well, folks, the tax bill can't be paid yet. And so the question is, well, how is this going to be handled on a closing statement? So let's do this first with a 360-day year. And I'm going to reiterate this. You're probably not going to follow along. I'm not teaching this to you. I'm showing it to you. Also, Brooke, Bill, that's my screen, not your screen. You're writing. Oh, you just haven't. Don't make me disable it, Bill. What are you saying? It's your birth. Oh, March 5th is your birthday? Okay. I picture. I'm like, listen, don't you be drawing anything weird on there, Bill. I'll have to disable the annotations. Okay. Normally people are like, oops. And he's like, all in it. He's like, I'm showing it's my birthday. Happy early birthday on March 5th. Now let me erase your drawing now that you've interrupted my stuff there, Bill. So March 5th, tax bill. The question that they're going to ask is, well, how's this going to be handled on a closing disclosure or settlement statement? And so the tax bill is going to be paid later in the year by the buyer. The buyer is going to swipe their card. So we need to take the seller's portion from the seller debit, and give it to the buyer credit. And so here's how you calculate this, okay? Using the 360-day, 30-day year method first. You are going to, let me get my calculator out. You're going to take your annual tax bill, and you're going to figure out how much somebody would be responsible for each day. So in this instance, $4,000 tax bill divided by 360 days in the year. We call this a per diem. Latin, again, translates to per day. So it is 11 a day. And then we need to calculate how many days the seller is responsible for. Well, that would be all of January, all of February, and the 5 days in March. Now, using this method, this is 30, 30, and 5. Does this make sense for everybody? 30 days in January, 30 days in February, 5 days in March. March 1st through 5th. Okay, 5 days. So that is 65 days total that the seller is responsible for using this method, times your per diem of 11 a day. What is the seller's portion of this tax bill? $722.15. That's not the answer. The answer is, well, how's this going to show up in the closing disclosure? It is going to be a seller debit, taking money from the seller of it looks like a 2. 722.15 and a buyer credit of 722.15. We are robbing Peter to pay Paul. This is the same number. Taking it from them, giving it to them. Why? Because when the buyer pays the full tax bill of $4,000 later in the year, it will be fair. Because they got the seller's portion at closing. It went towards their closing costs and other crap. Does this make sense? Remember, I'm not teaching this to you. I'm showing this to you. There's a difference. Now, let me show you the 365-day year. Can I repeat the language for the question? Yeah, the language for the question would be, a property is closing on March 5th with a $4,000 tax bill. How will the taxes be handled on the settlement statement? That's going to be the language. So let me move this down here, and we'll just put it side by side so you can see it does differ. It's not a crazy difference, though. So if they say use the 365-day year, that's a real calendar year. No, you will never have a leap year on your test. So here's what changes, okay? Now you take your $4,000 tax bill, and you would have to divide it by real calendar days, 365. So you see your per diem has changed. It would be $10.96 a day. And then when we calculate the days, that also changes. January, February, 5 days, February, March. It is 5 days in March. January has 31. February has 28. This is the difference. Same math, same methodology, different days, different, right? So now you've got 31 plus 28 plus 5 for a total of 64 days. And then 64 times your per diem of 1096. So if they said, okay, well, using the 365-day method, it would be a 701.44 seller debit and a 701.44 buyer credit. Same methodology, pain in the butt, because you would potentially have to do either or. What you got, Sinful?
Question, so the calendar years, 360 days, you said like this is a class test, okay. Anyway, during the class test, we can access our computer, we can be able to see that's okay, 360 is done. When they say, they will say, mention like a calendar days, 365 days, correct?
They will say, if they want you to do the three, you will default, even on the national test, you will default to 360 in 30 days. But they may say, do it using the 365 real calendar year. And when they do that, you've got to do it that way.
Okay, if they say 365 days, I don't have computer access, means how I know some month, January 31 days?
Excellent question. Here's
some other months, 30, 31, like that.
And this is why, Senthil, I think it made sense to do the 30-day month, 360-day year in the first place, because, listen, when our teachers once upon a time said, well, you're not always going to have a calculator in your pocket. Wrong. We got a calculator, we got a calendar, and we've got all the cat videos we could ever possibly need in our pocket at any given time, okay? They didn't know what they were talking about. So, Senthil, here's the only thing I can do to help you. There is a rhyme and there is a finger trick. The rhyme is, 30 days has September, April, June, and November. All the rest have 31 except for February, which is 28. It's a stupid rhyme. It barely works, but it works. Here's the best one, Senthil. You ready for this? Make a fist. Put your hands together. Just like that. Start on this side. Every place there's a knuckle is 31. Every place there's a divot is 30, except for February. January, February, March, April, May, June, July, and August are your back-to-back 31 months. September, October, November, December. That is the best trick I can give you. Knuckles together. January, February, March, April, May, June, July, August, September. Every place there's a knuckle is 31. Every place there is a divot, 30, except for February, which is 28. Yeah. And hopefully they'll make it easier on you.
Specifying 365 days, then we have to go 360. That's it.
Yeah, there you go. I don't love it. It's, it is what it is. But like I said, I'm going to teach you the actual prorations later. We'll practice some of these and some later stuff. This is just me showing you why we prorate to make it fair, right? At the end of the year, or throughout the year, we have closings, and it's not fair to make one person pay the full bill versus somebody else. So it's always about making it fair. Who would get screwed, and how do we fix it? Now, let me ask you a question. Okay, let's get into calculating the tax bills, because that is the math I'm going to teach you tonight. How to actually calculate a tax bill. Folks, here's my question for you. Do any of you not live in a county? I feel like Lena's starting to judge my questions some too, right? She's starting to make faces at me just like Brooks is. Like, she's like, I don't understand what this man is asking. Right? Like, what is he on? Jack says no. Sergio says no. Folks, it's kind of a trick question. I said, do any of you not live in a county? The answer is no. You all live in a county. The exception would be potentially an Indian reservation, a government base, federally owned land, something like that. But for all intents and purposes, you all live within a county. Let me ask a supplemental question. Do every single one of you live in the city limits of wherever your address is? No. So you can have a Raleigh address, but not be in the city limits of Raleigh. You could have a Fuquay address, but not be in the city limits of Fuquay. You could have a Wilmington address, but not be in the city limits of Wilmington. Case in point, folks, when you live in the city limits, you always have to pay the county tax rate. Always. And you would have to also pay the city tax rate if you lived in the city limits of Raleigh or wherever. So why is this important? If I say that Tara lives on the outskirts of Raleigh outside of the city limits, the city tax rate is this, the county tax rate is this, you better ignore that city tax rate. Because Tara's not getting charged the city tax rate, she's only paying the Wake County tax rate. But if I say Tara lives in the city limits of Raleigh, the city tax rate is this, the county tax rate is this, you're charging her both. Okay? Always, always, always you have to pay the county tax rate. And if and only if you live in the city limits, you also have to pay the city tax rate. You've got to be careful because when we give you these questions, we will give you sometimes extra information you don't need and you will have to know what to ignore. That's kind of the purpose of some of these things. Just take the money left and right. Yeah, absolutely. Anthony, that's what I just said. If you live in the city limits, you got to pay both. County taxes and city taxes. Now, going back to the difference between North Carolina and other states, some states have different tax rates, and I'm going to get into that in just a second. We in North Carolina, we use what's called a per 100 rate, and that per 100 rate is based on that assessed value. So we always take a look at the assessed value that the tax assessor came up with, which is not anything close to market value, and we say, here's what we're taxing you on. We are always basing the taxes on 100% of that assessed value. And we always charge you the county taxes, and if you live in the city limits, we also charge you the city taxes. But as I said, this is not the only method I have to teach you because it's a national test that has the math on it, not just the North Carolina portion. There's no math on the North Carolina portion of the test. It's all on the national side, so you can get both. Now, just a reminder while we're sitting here talking about taxes, folks, remember when we were talking about liens a moment ago? Real property tax liens are the highest priority lien. Special assessments are second to that, and then everything else is order of recordation. And so these are special priorities and, of course, done by taxing authorities. Just a reminder as we're sitting here talking about taxes. Now, before I teach you how to calculate the tax bill, which is important math, more than anything, it segues into other math. Let's give you a miniature math lesson in general, folks. Okay, miniature math lesson in general. Please understand, first and foremost, that we do not have time in this class for me to teach you basic mathematical skills. Hopefully you came into this class knowing multiplication, division, addition, and subtraction. And maybe even some decimals and fractions. But I'm going to give you a miniature lesson on those right now. And that's all you're going to get. If you struggle with basic math concepts, you're going to have to work extra hard to figure that out. And here's where, and I don't remember if I gave this to you yet, but I will give it to you again if I haven't, right? Let me give you the tough love piece. It's okay to not like math. It's not okay to not be good at math as a real estate agent because you are helping people invest hundreds of thousands, if not millions of dollars. So don't be like, I don't need to know this. That's why we have lenders. Yeah, sure. Lenders do a lot of the things in that regard, but you still need to have some basic math skills. And I always pick on people. You're going to be able to calculate your commission check. I know you're going to figure that out. So you need to be able to figure out the rest of it. And Anthony's like, facts. Then learn the rest of it, girl. Okay, listen. We're going to make sure you know it all. It's not just the commission check. So let's talk about percentages for a second, folks. Percentages, if you are not good with percentages, if you do not use them day in and day out, here's the trick. Okay, think of that word right there, cent. If I say 75%, in a calculator, it's 75 cents. If I said 50% in a calculator, it's 0.5, right? You can always just convert it to cents. So 100% would just be 1. right? If I said, what is 100% of 200? It's 200 times 1. It's just 200. It's itself. These are all based on a whole. And so anything over 100%, right, would be in a calculator as 1.25, 1.3, whatever. Now, if you're not comfortable with doing that conversion, thinking of it as cents, please understand, calculators are fantastic. If I said, what is 20% of 5,000? You can say 5,000 times 20 and then hit the percent button. It'll convert it for you. Now, be aware though, some calculators will finish the equation out. This one just converted it, and I still have to hit equals. But you can see what I'm saying. 20% was 0.2. If I said 5,000 times 75%, it's 0.75, right? Everybody okay with that statement? Pretty straightforward. Okay. Well, let's go ahead and throw another thing in the mix that a lot of people struggle with. Fractions. Folks, in fraction land, if I said 1 over 8 or 1/8 or whatever you want to call it, this is called a numerator. This is called a denominator. And what you may or may not realize about fractions, folks, fractions are very hard to work with. They're cumbersome, they're nasty, they're stupid. So don't do it. Here's all you have to do. They are their own equation. If you want to look at 1/8 as a decimal, think of that as a division symbol. 1 divided by 8. It is the equivalent of 0.125. And why is this important? Because you're going to see some random crap in some test questions like, oh, it's going to be like 4 7/8 as an interest rate. Well, folks, who has ever talked about their interest rate being 4 7/8? It's going to be on the test, though. So you know what you do? Start with the fraction, 7 divided by 8, and then add in your whole number, 4. That is 4.875% interest rate. Don't make it complicated. That's all a fraction is. Convert it to a decimal, you're good. Make sense still? All right. Buckle up. All right. Here's the next thing that I got to teach you. When we're dealing with real estate math, there are 2 ways to tackle everything. There is a very common practice called a T-bar that a lot of people like to utilize. I'm going to teach you how it works. But if you listen to, I'm going to name a concept. I'm going to talk about something here. And if this concept doesn't freak you out, you really don't have to memorize a single formula in this class. None. Zero. Zip. Nada. But if it freaks you out, you're going to have to do some memorization. Okay. I'm going to say a word, just one word. And if you throw up in your mouth, you're screwed. And if you don't, you're going to be okay. The word is algebra. Some of you got a good poker face. You're like, I don't want them to see me throwing up in my mouth. I'm just not going to make eye contact. I'm going to pretend I didn't. But here's the thing, though. When I say algebra, I mean the most simplistic version of algebra, like the 5th grade level. Okay, 5th grade level. Not the hard stuff. Let me show you what I mean here. Folks, I'm going to skip forward here. This is the T-bar, but before I show you the T-bar, let me ask you a question. Yeah, PEMDAS. Oh, God. We don't even have to worry about that, okay? Actually, we don't even have to go that advanced. Yeah, I know. Listen, I know y'all are going to drink tonight. It's fine. I get it, okay? There you go. So, if I was to ask you, ready for this? This is something that hopefully you can all do. If I was to ask you to write out the equation for 20% of 5,000, what would you tell me? How would I write that out? To the equation to find 20% of 5,000. I don't want the answer. Yeah, there you go.
Hey, Seth.
Yeah.
So, my 7th grade math teacher gave me a really good verbal thing to say for this. Is over of equals percent over 100. So, and you cross multiply.
Okay, no. Stop. Listen, it worked for you. I'm telling you, I teach adult learners day in and day out. You lost about 90% of everybody when you said cross multiply. I promise you did. You did. Let me show you this, okay? I'm going to take Ashley's because it's how my brain does it. A couple of you gave me different ways, and all of them are correct. But I'm going to take Ashley's, okay? So if you said, okay, well, it's 20% of 5,000, you would just put in a calculator, or you would write out 5,000 times, I just told you how to convert 20% into a decimal, times 0.2. That is the equation for finding 20% of 5,000. Everybody's okay with that, yes? Okay. Well, I also like what Donna did, and that's what I'm going to go back to, but let me show you the math here. Now that you have linearly put this together, putting it in a calculator, 5,000 times 0.2 gives us 1,000. And so when we're talking about algebra, folks, Donna put 5,000 times 0.2 equals x, or the other way around. And that's all algebra is. That's when they introduced letters to math. And we're all like, there's letters in math? And it was like, you got to find the value of this. And so you just plug in a letter until you find the value. So what if I said, for example, what percentage of 5,000 is 1,000? Well, folks, it's the same linear equation. What you're really saying is, okay, 5,000 times what equals 1,000? And so as opposed to putting a question mark in here, we put, I'm not going to put an X because that's always what I use for the multiplication symbol. I'm going to put R for rate, okay? What percentage of 5,000 is 1,000? And so all algebra was getting everything to one side of the equation to figure out the unknown variable. Well, folks, if it's 5,000 times R, divide by 5,000 on this side, divide by 5,000 on this side. And now what you've really said is, okay, well, the percentage rate is 1,000 divided by 5,000. So 1,000 divided by 5,000 is 20%. It is the most simplistic form of algebra because if your brain does linear equations automatically. So if you can remember linear equations and just take out what's missing, you can always find the answer, and this will work for every math concept in the entire class. I promise it will. Now, if you're like, what did this man just do? Let's talk about the T-bars. I got you. But I'm telling you, your life will be so much easier. I like that, Jack. Maybe something stronger than a cigarette, Jack. I don't know. Here's the thing. Let's just look at it. Okay, I'm going to compare the two here. With a T-bar, folks, let me be completely and brutally honest with you. A T-bar is a visual crutch for people who can't comprehend linear equations. That's what it is. Let's just call it what it is. And so here's how this T-bar works. There is this T that you see right here. T, letter T, like Mr. T. And what happens is you look at it from the whole, the rate, the part. And you can plug it in to this T-bar. And so if you have the whole and the rate, you would multiply them together to get the part. Here's the whole. Here's the rate. You multiply them together to get the part, the piece. But if you're missing one, like we just did, like the rate, you've got the whole, you've got the part, and so when you've got the one at the top, you divide down the T. This is a visual representation of what I just did. 1,000 divided by 5,000 equals 0.2 or 20%. That is all this is. It is a visual representation of where to plug crap. The problem is they're not always called wholes, they're not always called rates, and they're not always called parts, but that's how it always gets plugged in. Sometimes they're called per 100 rate. Sometimes they're called percentages. Sometimes it's, area calculation. Sometimes it's length and width, right? There's a lot of different pieces. But if your brain can just remember the most basic of linear equations, you can solve any math in here because you can just take out what's missing and then rearrange it. Just find for that missing value. That being said, some people are math brain people and some people aren't. Sometimes easier than others.